Vidhi, we can proceed.
Good evening, everyone. A very warm welcome to each one of you joining us virtually today. I, Vidhi Kamlesh Darji, your host for today's session, is thrilled to welcome you to the Gyan Yagna series, Knowledge Beyond Powers, organized by Vikasa WIRC of ICAI. Tonight, we embark our journey to explore the fascinating world of valuation titled Valuation, the intelligence behind investment. Let's take a moment to honor our professional values with the ICI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you to the team and everyone for joining me in this moment of reflection. I now kindly request our Vikasa Chairman, CA Jitendra Saglani sir, to give a welcome address and set a tone for today's discussion.
Thank you so much, Vidhi. Chairman of WRC, the dynamic CA Ketan Sayya sir. Speaker of today's session, CA Chirag Kothari, who happens to be from Nagpur and is an expert when it comes to the topic of valuations. And he also set the tone by structuring this particular program, the entire series on valuations. Thank you, Chirag bhai, and we welcome you all on this forum of Vikasa WRC. The team Vikasa, Vice Chairman along with me, Parth Thakkar, team member of Vikasa, Mr. Madhur Bhartiya, and the two extended arms of Vikasa, Vidhi Darji and Jainam Sarvaiya. And all my dear participants, a warm welcome to you all on this occasion, wherein we have the series Yagna, Knowledge Beyond Borders. And I think today is an apt session for you all because we chartered accountants are meant to do number crunching. And when it comes to valuations, the best part is we play with numbers a lot. And this particular program of valuations is actually planned to take you through this journey in the exciting world of valuations. And I think this program, the entire series, will add a lot of value. It will help not just in your exams, but also in your journey when it comes to, handling assignments of valuations. Friends, valuations play a very critical role in finance, and understanding its concepts and application is essential for professionals as well as students. Our esteemed faculty today will guide us through the intricacies of valuations, and I'm confident that this session and series will provide you valuable insights and knowledge. I wish you all a very fruitful and enriching experience, and let's learn, grow, and explore the world of valuations together. With these words, I welcome you all in this series and looking forward to more exciting sessions on valuations. Once again, welcoming the faculty, CA Chirag Kothari, and over to you, Ms. Vidhi, for further proceedings.
Thank you so much, sir, for your inspiring and warm welcome. Now, to steer into the theme of today's session, I take this opportunity to invite our WIRC Chairman, CA Ketan Sayya sir, to deliver the opening remarks.
Ketan sir, Chairman sir, दूसरा meeting में sir चलेगा sir.
And your value. Okay.
Hello, Vidhi.
Yes.
As Ketan sir is not available, I would request Janam to kindly introduce our esteemed speaker so that we can proceed further with our very exciting session.
Mm, Good evening, ladies and gentlemen. It's our pleasure to introduce Chartered Accountant Chirag Kothari, a distinguished expert in valuation and financial advisory services. As the founding partner at Chirag Kothari and Associates in Nagpur, Mr. Kothari brings 8 years of experience in serving listed and multinational clients across various industries. With a background in commerce with honor as a practicing fellow member at the Institute of Chartered Accountant of India and a licensed company secretary. Mr. Kothari's expertise spans assurance, advisory, and valuation services. His previous role as an executive in assurance department at Ernst and Young, that is EY India, has provided him with valuable insights and expertise as a registered valuer with Insolvency and Bankruptcy Board of India, that is IBBI, for securities or financial assets, that is SFA. Mr. Kothari's core competencies include valuations for M&A, that is merger and acquisitions, startup valuations, and right issues. He also excels in transaction and risk advisory, CFO services, and business tax planning consultation. Today, Mr. Kothari will share his valuable insights and expertise on valuation, helping us to navigate the complexities of this critical aspect of finance. Let's welcome Mr. Chirag Kothari and learn from his experience. Please join me in giving a warm welcome to Mr. Chirag Kothari. Thank you.
Okay. Thank you so much, Janam. Shall we start?
Yes, sir, we can proceed with our session.
Okay. Thank you so much, Madhur. First of all, thank you so much, Jitendra sir, for such a great platform for students across Western India Regional Council as well as all over India. I think this kind of topics are very, very important when it comes to not only from the academic point of view, but I think it will be more helpful from a practice point of view or professional career point of view. Uh, I really hope get good inputs, value addition to your learning from this webinar. And what we'll do is we'll start with the presentation. I think we will have a more of informative session. I'll be discussing various topics as well. Uh, Post You can post your questions, but what we'll do is we'll take the questions at the last, I believe. So let us start with the topics immediately. I'll share my screen so that you are visible. You can view the presentation as well. So is it visible?
Yes, sir, it's visible.
Yeah, thank you. So, as my introduction is already done, I'll immediately start with the topics. So, basically, valuation we have. So, I'll be conducting two topics. So, first topic today is valuation and financial statement analysis. First, we'll try and understand valuation, what valuation is, why valuation is required, and then we will move on to financial analysis. Uh, Also, along with that, tomorrow the session we have is valuation approaches, the tools that is used in valuation. So, what I would like to bring to your notice is we'll discuss this topics. These topics are a combination of altogether what valuation is. So obviously it can't be done within one session. So we have The extended part will be, the tools and the approaches. Obviously, we will take it up tomorrow. We'll have a foundational level or the basic valuation uh, understanding, what it is used for, why it is required, how it is done, what are the basic principles, what are the premises. This is all the basic things that we'll understand in this session. So let me just yeah. So what I've done is the topic for today I've divided into, so we will discuss in two parts. First, it will be totally valuation, wherein we will understand the definition of it. Along with that, we'll also discuss about its principles and brief about its methods. The methods are altogether, kind of tools that we will take up in the next session. Then we will, jump on to financial statement analysis and its components. It will be more or less, we will discuss this together so that, you can have a altogether overview of, why financial statement analysis is important, how it is done, and what are the, things or the line items that are required for valuation. So let me just start with this. Uh, so understanding valuation. So it's a very basic, very basic question. So why valuation is required? What is the basic need for valuation? I hope you guys know about valuation. A brief about valuation you might have in come across in your academics. So when I talk about valuation, it's a professional judgment about how much money is something worth. Now, when I say how much money is something worth, let me just emphasize more on professional judgment. Why professional judgment? Because it involves interpreting and applying various methods, data, and assumptions to estimate the value of an asset, business, or liability. This process is not purely mechanical, it requires expertise, experience, and subjective decision making. Valuation is a professional judgment. It is not a formulaic output, but if you carefully consider the conclusion that the balance is technical analysis with professional experience, it professional experience when is important is when there is uncertainty in the data, when the data is limited, or you have to use various assumptions to cater to that particular valuation. So now we know why professional judgment is required when it comes to valuation. So we have to understand the worth of that particular asset, business, or liability for that matter. So now the next question is why valuation? See, valuation is required. Obviously, the primary reason is to make an intelligent decision making. This is the prerequisite in, it is knowing the worth of an asset that determines its value. It can be, for investment for a portfolio. It can be for merger and acquisitions, whether to pay, how much to pay or to receive, what should be the price, and an investment or financial or dividend choices that we do in a running business. So this leads us to a business valuation. So now we have divided valuation for understanding it as a business valuation point of view, which can be used for financial decision making, investment decision making, or dividend decision making. It is not only restricted to that. It is also for M&As, startup valuations that we have, we come across on a regular basis. uh, Now, when we talk about to value something in business valuation, as I mentioned, there is a lot of uncertainty, limited data is there are variable assumptions that we need to make. For this, we need to have a premise, which leads to which can, for which we need to make a reasonable estimates of values for most of the assets, and some same fundamental principles uh, are there for valuing different types of assets. uh, to understand this, let us take a business valuation from an investor point of view. An investor does not pay more for an asset than it's worth, right? Obviously no one will be paying for more than it's worth. It's obviously it sounds it exactly sounds like investing. Obviously it's very logical and obvious. However, it is generally discovered that the value is in the eyes of beholder, and that any price can be justified if there are other investors who are willing to pay the price that the beholder asks. So let me tell you, it's patently absurd. Perception may matter when the asset is perception will obviously matter when it is a painting or a sculpture. There are aesthetic reasons or emotional reasons behind it, but valuation has to have certain cash flows, or we need to uh, understand ki there are cash flows generating from that particular asset, and what are the cash flows worth as on today to justify the worth of that particular asset. There are many aspects of valuation where we can agree or disagree, including estimates of true value and how long it will take for prices to adjust to that true value. But there is one point where there can be no disagreement. Assets cannot be justified by merely using the argument that there will be other investor who will be ready to pay higher price for future. It is very equivalent to like a game of musical chairs, where every investor has to answer the same question: where will I be when the music stops before playing? The problem with investing with the expectation that there will be a bigger pool around to sell that particular asset, when the time comes, it might be you who can be end up with that on the place of that particular bigger pool that we are talking. So that is why valuation is one of the key factors which is required for to understand the worth of an asset. So let us just I'll just explain the valuation process to you. There are two extreme views about valuation process. So some people uh, say that valuation is science, where it is purely analysis. There is very little room for professional judgment or assumptions or premises that we use. Also there are the other those who feel that valuation is more of art, where savvy analysts can manipulate numbers to generate whatever results they want. Actually, the truth lies somewhere in the middle of both. It obviously has various analysis, various formulas, which can lead us to derive into a particular value. But as I told you, there are a lot of uncertainties, variable assumptions that you have to make to reach to a specific value. So therefore, we can't just say valuation is a science or art. It is somewhere in the middle. You obviously have to have analysis, various technical formulas, and you have to generate a value from that. But also you have to have your professional judgment is very, very important in that matter. Okay. So, what is, so after why valuation, we will understand, basic principles, on what valuation is standing on. So basically, अगर हम बोलें कि हमारा valuation का basis क्या है? So, there are three important principles of valuation. One is relative valuation, the second one is intrinsic valuation, and the third one is market valuation. मैं एक एक को I'll just explain you in detail so that you have a better idea of what every principle, each and every principle stands on, right? So, relative principle may, while we focus in the classroom and academic discussion, it remains more or less on discounted cash flows. Most of you have already heard of it. Uh, but the reality is, most assets are valued on relative basis. When I talk about relative basis, in relative valuation, we value an asset by looking at how the market prices of similar assets are working. So thus, when determining what to pay for a house, for example, we look what similar houses in the neighborhoods are sold for, rather than you know uh, calculating the intrinsic value of that house. You obviously have to have the market idea of that, right? So extending this same analogy to stocks, investors, they often make decisions whether what are the industry for a specific industry, what are the similar assets or similar stocks behaving like, what are the ratios, what are the valuation, how is the valuation derived, you know so that is how we derive a relative valuation for an asset. So uh, so in this section we will consider the basis for relative valuation, why, ways in which it can be advantages, what are the advantages and disadvantages of it. So in relative valuation, the value of an asset is derived from the principle of comparable asset. So where you herein we compare assets using a standardization method, using a common variable, to be very simple, to make it very simple. So basically there are two components for a relative valuation. The first is to identify a comparable or a similar asset. So for example, if you are valuing for example, if you are valuing something, a IT industry, right? IT company. Obviously, what you will do is you will, while valuing for, through a relative valuation, what you will do is you will check for similar IT industries, or similar companies in this particular IT industries. You will extract those two or three companies, and you will check whether the businesses of this IT company is similar to that particular IT company. So this is what is standardization known as, where we compare this companies to a similar asset. From a valuation standpoint, this would imply assets with similar cash flows, risk, growth potentials. In practice, it is usually taken to mean other companies that are in the same business as the company being valued. After all, the price per share of a company is sense of arbitrary in function. So, dividing the price or a market value of some measure that is related to that value will yield a standardized price. So herein we use various multiples. I hope you might have come across various P multiples, EV by EBITDA. So this multiples we use, we first understand what are the comparable companies. We take that ratios or the multiples from that companies, and then we standardize or use it into a company that we are valuing. Uh, so what is the principle behind relative valuation? It states that a value of an asset, company, or investment can be determined comparing to its similar assets. It's a basic thing that is done in relative valuation. So you have to, this becomes very simple for listed companies may, you can have a very good idea of how the company is behaving, because the shares are openly in the market, sold, bought and sold in the market. But for a closed-ended company, it becomes very difficult. You have to have understanding of how the company works, what are the what is the understanding of the business. You have to have a very good understanding of the business. Then you have to find that companies into same business or same line of operations, have a same cash flows. Then you have to take the ratios from that companies, and then you use it into our company that we are valuing. Also, you just can't take the multiples or ratios from that company and use it in our company. You also have to discount it. So we will obviously discuss this, how do we discount it and how it is done. But this is the general understanding of how relative valuation works. So basic core concept of relative valuation is you don't value an asset in isolation. It is not an asset per se. You value it in relation to what similar things are, right? So no rational investor will pay more for one asset when obviously there are similar assets of the same class available. Therefore, market prices of comparable assets acts as benchmark. So how it works, as I told you, we have already understood how it works. Some of the key multiples. Let me. Obviously, you might have come across this. You might have known about. You might know about PE multiple. It is price earning. When it is used, when there are stable earnings in a company, there is a common equity value. Then another one is EV by EBITDA. It is also one of the very good and very commonly used multiple. EV by EBITDA we use majorly because we have a good understanding of the cash flows of the two companies. When there are similar cash flows of where when we are comparing with other companies, we use EV by EBITDA. Then another one is price to book value, PB ratio. When there are when the company is asset heavy, then we use price to book ratio, multiple for that matter. Then there is also enterprise value by sales, EV by sales that we talk. आप लोगों ने बहुत बार शार्क टैंक में सुना होगा कि सेल्स का मल्टीपल ले रहे हैं. However, there are a lot of losses in the company. So sales ka multiple is taken when there are early stage startups or loss making companies. Then we use this kind of multiples. So there all obviously relative valuation has certain limitations to it. See, as I have already emphasized, कि relative valuation में it's always a comparable company. So you obviously have to trust on the peers that exist. You are not very much aware कि insider what the company how it is functioning inside, right? You only know the values, the data that is available in the market. However, you have to rely on that peers, whether they are performing, actually they are performing operationally, they are performing good or not, right? There is also a second limitation to it. It assumes that market is efficient. It can't be always that market is always efficiently behaving, right? There are obviously various changes across happening in the market. There are a lot of dynamic it's a dynamic market, so you have to assume that there is market efficiency. The third limitation that I want to talk about is it does not reflect intrinsic value. अभी तक हमने रिलेटिव वैल्यूएशन में कहीं पे भी इंट्रिंसिक वैल्यू की बात नहीं की. Intrinsic value, I will obviously jump onto intrinsic value in a short while, but intrinsic value is the real value that we talk about, right? When I'll talk about intrinsic value, we will discuss that in detail. But intrinsic value is a detail, it's a real value that of the company. So obviously relative valuation does not talk about it. So with this, obviously, I hope you understood what relative valuation principle talks about. Let us talk about intrinsic valuation. Intrinsic valuation, as I told you, intrinsic value is the real value of a particular asset. So how do we know what a company, what a real value of a company is? do we have, some information about it? How do we calculate a real value of a company? So this is where, your professional judgment, your analysis, and majorly that you must have, you all know about your discounted cash flows, the cash flows of the companies come into picture. Intrinsic value को अगर मैं एकदम, if I talk about intrinsic value, it just says कि what the worth of an asset will be. Inherent worth of an asset is, inherent worth lies majorly on the cash flows of that particular company. How are the cash flows? What is the potential of that particular company? How it is independent of the market perceptions. So intrinsic value principle states that the true value will of an asset will be based on the fundamental characteristics, particularly its ability to generate future cash flows. Obviously, it can't be just cash flows. You can't just be you can't just say, okay, these are the 5 years cash flows, and based on that cash flows, my company is worth today is worth this much. It obviously has to be adjusted with time and risk, because obviously time value of money, you all know, there are also risk associated with that. So we will obviously understand time, risk, and as well as cash flows when we discuss about discounted cash flows, in detail. Uh, so the core concept of intrinsic value is an asset's worth in the present value of its future cash flows, that is it is expected to generate. It is obviously considering the time value of money and the economic fundamentals, and it is not talking about market prices, right? This is the most utilized, or the it is the most commonly used uh, principle across the companies, because majorly investors are looking for the intrinsic value, and it reflects its real value. So therefore, majorly the valuations are done in this intrinsic valuation principle. So when I talk about intrinsic value, there has to be the foundation for it. So the foundational methods, or I can say, for intrinsic value is the DCF, discounted cash flows, and the net present value. So net present value again has certain limitations, but majorly discounted cash flows models are used for intrinsic valuation. So we will discuss in detail when we talk about DCF models. DCF model is again a very, very important model when we talk about the strength. When I talk about the advantages of intrinsic value, it is purely based on fundamentals, right? It is useful for long-term investors, and it helps to identify whether that particular share of a company is overvalued or undervalued. So it reflects its true potential. See, obviously, it is not a perfect valuation model. Uh, every valuation model has certain disadvantages attached to it. So for DCF, when I talk about intrinsic value principle, or DCF for that matter, uh, this there is certain limitation to it. It is highly sensitive to assumptions. There are a lot of assumptions when when you do a DCF. For example, the growth rate is one of the important factors. What do you assume? So it is solely the it is solely on the discretion of a valuer, what growth rate it is assuming, he or she is assuming for you know uh, for that particular company or an asset for that matter. Along with that, there are discount rates that we uh, assume. again, all these things, when we discuss DCF in detail, we will understand it in a better way. The second limitation that I want to talk about is, when we talk about DCF, there has to be forecasts available. There are financial projections. When we discuss about fundamental financial statement analysis, therein we will understand how analysis how what kind of analysis is done while doing DCF method, or what inputs are taken from for DCF method when we do fundamental financial statement analysis. So the forecast that we do can be, obviously you can't predict exactly what is going to happen in future. It is highly speculative and uncertain. So this is a limitation for DCF or intrinsic value principle. It is comparatively more complex. It is more it has to have more data. It is data intensive than relative valuation. So relative valuation may, you have to just have a comparable company, similar company, and you have to take that particular multiple and use it in your valuation. But here in DCF, you have to have a detailed analysis, a detailed working. You have to bring various assumptions to the picture, and then obviously derive into a value. So comparing intrinsic value and relative value, uh, obviously intrinsic value is more of future cash flows based, or it we talk about the cash flows that it is going to generate, the business is going to generate in future, whereas relative valuation is more of market comparables, right? The key tool for intrinsic value is DCF, and for relative valuation is multiples that we use. When we talk about relative valuation, you might have come across various startups. When we talk about various startups, most of the startup valuations are also done using relative valuation, which is comparatively very fast. It is market reflective. Therefore, at that point of time, relative valuation is done. Uh, and when we talk about intrinsic valuation, it is more of a long term, or grounded in value for that matter. Uh, so, see, relative valuation and intrinsic valuation again are the two important pillars of valuation. Now, the third is market valuation. See, market valuation is very simple. Obviously you all have the fair idea of share market and its trading, the how the market runs. There are active sellers and buyers in the market. So all the shares listed in the stock market have its market price, because there are a lot of buyers who are willing to buy that particular share, and as well as there are a lot of sellers who are willing to share willing to sell that particular uh, share. So market value is very simple. It it just reflects, sorry, it just reflects what is the market price of an asset, where it is totally influenced by demand and supply. The market prices are worked, or it are these are derived truly based on demand and supply. So let us move on to various valuation methods. These are just a few methods that are used. There are a lot of methods or tools that we do valuation from. We will discuss valuation methods in detail, obviously in the next session. However, there is DCF method. I think I have given a fair idea of DCF method, the basic of DCF method, how it works. There is comparable company analysis, which is obviously a relative valuation principle. Precedent transactions, again, it is a part of relative valuation principle, wherein the recent transactions are taken into picture. They have, we take the basis of that particular transaction that have already taken place, and then we carry out the valuation of the specified asset. The last one is asset-based valuation. So here, mostly when we talk about asset-based valuation, uh, the net asset value that you might be aware of is the common method that is used, uh, wherein assets are reduced by liabilities, and the net assets are derived to uh, calculate the uh, price of the share or the value of that particular share, right? So let us move on to the components of financial statements. You guys know much better because you are already into this very deeply academically. The components of financial statements. See, rather than talking about the components of financial statements, let us understand the components of financial statements. What are the components that are used from a valuation point of view, right? Obviously, when we are talking about valuation, what are the components or line items that are used for used for valuation perspective? So when I talk about components, so there are, obviously, balance sheet is divided into assets, liabilities, and equities. Assets, these are the resources owned by the company that have economic value, including cash, inventory, property, and equipment. Liabilities, these are the financial obligations. Uh, and equity, again, it is the shareholders' stake, indicating share, it it represents the interest, ownership interest in the company. It is obviously assets, total assets are reduced by total liabilities to derive to a equity. So when we talk about income statement, uh, what are the components used with respect to valuation? See, this is not only specific to DCF method. It can be used, all these components can be used in various types of valuation that we do, various types of valuation methods that we follow, right? Revenue, obviously, what is revenue. It's the income that we derive from the business operations, right? Either it can be sales of goods, services. Then expenses, these are the cost incurred by the company, right? Salaries, rent, depreciation. Net income is very important for using various multiples. It is used for various multiples. Also, it is used for while calculating, you when you use a DCF method. Again, this is a very important component, cash flow statement. Cash flow statement is obviously, the detail about cash flow statement, but when we talk about DCF valuation, cash flows are very important. When we talk about cash flows just, when we value a company through DCF method, we derive free cash flows, um, that are, free cash flows that are generated from the company. So free cash flows is used to value a company or a particular share. So business as a whole is also valued through free cash flows, as well as uh, the particular share is also valued through free cash flows. How it is valued, we will obviously discuss this in detail when we talk about a DCF method. So cash flows again is very important. Uh, Also, with respect to decision making, as I had mentioned while talking about valuation, for financing decisions, whether dividend is to be, how much dividend is to be paid, or how much investment is to be done in the company, how much financing, how much additional working capital is required, or how much additional uh, equity or loan is to be infused in the company to have a to analyze or to have a long term view of the company, or to make a decision making for that particular project or investment of the company. So all these components leads us to financial statement analysis. How to analyze financial statements uh, in evaluation. So I have prepared a basic process what is to be done while analyzing financial statements. So I'll just discuss about the process. I'll just give you the brief, then we will go on to the details of that. First and foremost, you have to identify or figure out what is to be valued. Once you know what is to be valued, then you can move forward to generate the information that is required from the financial statements. So first and foremost is obviously to figure out what you need to value, right? For example, I need to value shares, right, of the company, or I need to issue shares, therefore I need a valuation of that particular shares. So when I need to value that particular shares, I need to generate, or I need to get all the inputs, relevant inputs from the financial statements that are required to generate information for my for valuing that particular share. So once you get all the inputs or the information, you have to understand that particular information, and then you have to use that information into a specific you have to use that particular information into what you need to generate from that particular information. So for example, if I talk about balance sheet or profit and loss, when this components, when the line items are used from the financial statements, this help us to generate trends, or uh, what I mean to say is this helps us to generate projections or the cash flows or the ratios that are required, whether the company, how is the company performing, and how are the operations of that particular company. So it does not only tell us these are the revenues, these are the expenses, or this is the net profit of the company, but you have to also analyze that and analyze the information to generate certain information from that, right? So you have to get various ratios. You have to have a horizontal comparisons, you have to have a vertical comparisons. What are horizontal and vertical comparisons? Obviously I'll come in detail about it. Once you generate some information from that, then you have to identify um, the trends and the patterns of that particular components. How is the company going to perform in the next 5 years, for example? And then once you know that, then you can use that particular information to to the relevant inputs that is required further for valuing the shares. So financial statements, when we do financial statement analysis, it is not just restricted to internal sources. Obviously financial statements, financial analysis, when we do financial analysis is divided into two categories: internal sources and external sources. So obviously the internal sources are annual report, balance sheet, profit and loss, cash flows, changes in statement of change in equity, notes and disclosures, The external sources to financial statements can be the details of traded company, market transactions, industry studies, publications, etc. Uh, these are all the information that you need to generate while valuing a particular company, right? What can be the areas of focus? The capital structure, working capital cycles, market shares and positions, credit ratings, business and reporting environments, operational scale efficiency, life cycle of company. Uh, Let me just go through the analysis part. Then we will discuss the ICI valuation standard. What does it say for valuation? So let us first complete the financial analysis part. So when we talk about financial analysis, there are various analysis that we do while valuing a share. Uh, so first is obviously ratio analysis. Ratio analysis is very, very important from the point of view of, whenever we do ratio analysis, it uh, it just helps us to know or understand the operational efficiency of the company, right? What are the what exactly how is the company functioning? Uh, for example, if I talk about gross margin, right, it helps us to the cost control and the pricing power of the company, right? Operating margin, it helps us to understand the operational efficiency of the company, right? Net margin, overall profitability of the company, correct? uh, ROE to ROA. So it is basically net income by assets or equity. It reflects the return on capital of the company, right? So when we talk about liquidity ratios, there are various liquidity ratios that are utilized or used when we do financial statement analysis. Uh, some of the liquidity ratios can be current ratio. Current ratio is again a working capital. It helps us to understand the working capital of the company. It just it's used to understand the short term liquidity of the company, correct? Debt equity ratio, it helps us to understand the capital structure, uh, the risk associated to the company. Then there is interest coverage ratio. It helps us to understand debt servicing capacity of the company, correct? Then there are various profitability ratios that I've already discussed, like gross margins, net margins, operating margins. Uh, so in profitability ratio, uh, the major portion or the major component that we use is EBITDA. EBITDA is it helps us to derive various ratios. It also helps us to know the operational efficiency of the company, right? So further we will understand how is EBITDA used and what how EBITDA is used for valuing the company, and how it is a major component while valuing a particular share or a company for that matter, right? Then there are various other ratios apart from that, that can be efficiency ratios, the asset turnover ratios that we use. It helps us to understand the asset efficiency of the company. Inventory ratios, COGS by inventory. It helps to how understand how the inventory is managed across. uh, let's move on to ratio analysis, again a very very important part. Trend analysis. Trend analysis is very very important when we talk about DCF calculations. DCF calculations, as I told you, it helps us to uh, derive cash flows that will be generated in future. They are discounted and discounted into into their present value, and then we value that particular company or share for that matter. uh, so when we talk about trend analysis, there are two types of trend analysis. One is horizontal analysis and vertical analysis. Horizontal analysis is, something that compare line items over multiple periods. So when I talk about 5-year projections, so trend analysis, may horizontal analysis helps us to understand how the company is going to grow, uh, how are the cost related to the company, or the expenses for that matter, how are they proportionally going to increase over the period of time. uh, this analysis is majorly used for preparing financial projections. uh, Financial projections are generally, whenever we value a particular company, the management provides us with the projections, but you as a valuer have to understand how these projections are, how the data is flowing, how are the line items in the projections growing year on year. Based on that, you can raise, you can be skeptical, you can raise various questions based on the understanding that you have of the company. Another analysis, along with horizontal analysis, is vertical analysis. It is majorly used for common size statements, right? I hope you are aware about common size statements. So basically, it expresses each line item as a percentage of base figure. So when I talk about total revenue, right? Total revenue, generally we take it as 100%. So total revenue ka what percent is the expenses line items? For example, salaries ho gaya, debt for that matter, operating activities, right? Various expenses in the operating activities. So herein we allocate certain percentages to each and every line item in the balance sheet or the of profit and loss for that matter. It helps us to compare companies of different sizes, right? When we talk about gross margin, so we can easily understand what is the gross margin or the gross profit with respect to sales. So along with trend analysis, what we do is comparative analysis. So comparative analysis may majorly we compare industry, we have industry comparisons. So it involves analyzing a company's financial ratios against industry averages, providing insights to competitive position and identifying its strength and weaknesses. Also, there is analysis. We do benchmarking. It is a process of measuring companies' performance against best practices for other organization. Uh, Let me just go through the IC. Let me just help you understand what ICAI standard on valuation says. So basically, this valuation standards on ICAI, it's standard 201. We call it IVS 201, right? Herein, ICAI has so obviously ICAI has issued various standards, valuation standards with respect to valuation. Obviously, we will discussing one more valuation down the line when we have another session of uh, valuation approaches. Valuations standard IVS 201 says what an valuation engagement covers, right? Uh, it says valuation engagement covers arriving at an estimate of or providing an opinion of value. So we are arriving at a value. We are just providing our opinion, right? By giving an estimate of the estimate of a share value, or for example a asset value or a business value for that matter. So what we are doing is we are arriving at an estimate or providing our opinion of value. Second, it says fairness opinion, which involves opining on the fairness of a price at which transaction has taken place, or on the fairness of value conclusion of another valuer. So herein we state a fair value, what the company, what a company, what a share of company, a fair value of a share is, or a fair value of an asset is. Uh, we arrive at a fairness of the price, right? We can't say that this value is exact value of that particular share. Obviously, it will be a fair value. It is derived through various analysis or formulas that we uh, deal, or the methods that we use. Then the third one is valuation review, where the work of another value is reviewed. So you being an expert of securities and financial asset, you can't have expertise over other assets as well. Other assets, when I talk about, can be land and building, can be plant and machinery, right? So when we talk about using the work of another valuer, you have to uh, consider the value that is derived by the another valuation expert for the land building or uh, plant and machinery for that matter. You have to consider that value, the valuation report that is issued by the another valuation expert, right? The extent of analysis to be carried out by valuer in relation to engagement shall be based on the purpose of valuation assignment and the terms of engagement. The judgment made by valuer during the course of assignment, including the sufficiency of data made available to meet purpose of valuation, must be adequately supported. So whatever judgment you are making for that matter, when we talk about risk or the growth rate, whatever judgment, professional judgment you are taking, your professional experience you are involving into that valuation, you have to have a proper supporting, or the data, the document should be backed uh, for the professional judgment that you make. The valuer shall carry out relevant analysis and evaluation through discussions, inspections, survey, calculation, and such other means as may be applicable to that effect. So obviously, the analysis that we have talked about, uh, the discussions should also be there with the management. There need to be proper inspections on the financial statements. Your calculations needs to be apt, should be exactly what is what the method says. And uh, you know every other assumptions that you make needs to have a proper basis and a proper uh, understanding with proper backing on that, correct? So I think we have covered the basic part on valuations. uh, let me just summarize it to you. See, whenever we do valuations, valuation again is obviously a professional expertise. It it is purely the methods that we use. It is purely on the methods that we use, how we use that method, when to use a specific method is again an area of expertise. How how is the company behaving, how is the company functioning, how is it operating, all these factors define the methods to value a particular company. All first we once we understand what exactly principle we are using in valuation, all other things follow along with that. whenever it's a relative valuation, you have to have a different kind of analysis. Whenever there is intrinsic valuation principle, there is altogether a different uh, you know procedures that you follow, or you have to have a different kind of professional judgment when you are dealing with intrinsic valuation principle. Market valuation principle, again, it is altogether a different profession. Again, it's a different professional expertise that is derived, when you calculate options, for that matter. Or again, there are uh, there has to be specific understanding whenever you value a company or an asset, or liability, for that matter. Nowadays, uh, intangible asset valuation, ESOP valuation, startup valuation, it has gained a lot and a lot of importance. uh, Apart from all this, there is obviously uh, uh, you know you have to value, you need valuation reports specifically to comply with various provisions. Income Tax Act says 11UA valuation, FEMA says ODI valuations. There is Companies Act valuations, where there are various provisions for to value a particular share under various provisions of Companies Act, and wherein a specific valuation expert, or the report from that particular expert is required. I think keeping all this things into picture, and the dynamics of the market changing drastically, the need for valuation has increased a lot over the period. Initially, valuation was 2000. I remember very clearly, 2017 or 18, the valuation rules had come into picture. uh, Post that, valuation has gained so much importance throughout. AIF, we do for various we do various valuations for AIF, uh, shares, equities, ESOPs, as I have already mentioned, intangible assets. So every asset class, or uh, every business that we value has a separate story behind it, has a altogether individual or independent considerations, uh, or the what we can say, inputs uh, are very very independent and inclusive of the valuations that we do. So keeping all this in mind, merger and acquisition valuation, again, a very very important area. IBBI, insolvency valuations, again, a very very important area. So keeping all this considerations, this valuation uh, subject, or the valuation assignment has increased, or has taken a great importance into the corporate culture, as well as for the government. uh, Obviously, globally, valuations are again altogether a different scenario. There are global evaluations taking place. IBSC is doing a lot, all across the globe. uh, there are valuation experts, certified valuation experts, doing valuations throughout for various companies, MNCs. So keeping all this in mind, and considering all these aspects, it's a very very niche area to work in. And it will help you not only in your industrial point of view, whenever if you wish to grow your career into industry, or practice. Both ways, it is very very helpful, and it is going to impact you some or the other way. So with this, I like to conclude my presentation. I'm open to any questions, you guys.
So you're not audible. I
I've concluded my presentation. You
yeah,
guys
yeah.
can
But
have
I assume
open to
I assume.
questions.
Oh, okay, okay, okay. Um, so as of now, I don't find any questions. Okay, we have some questions.
Yeah.
Sir, actually, this is a question relating to guidance for from a student who's confused between either they should go for valuation or for auditing.
Okay. Uh, so see, whether to go for audit or valuation, again, these are two extreme, areas of practice. Uh, I have been into audit. I've been into assurance for a while, and when we talk about audit, assurance is altogether, uh, talking from a regulator's point of view. Uh, and when we talk about valuation, it is altogether a different thing. From a financial perspective, financial statements perspective, valuation, we in valuation we do not uh, check in detail whether the figures are correct or not. We only rely on the management. And when we talk about audit, you have to be skeptical. So it is different, altogether different role. uh, Again, if you find yourself more inclined, you are very audit interests you, uh, you can perform various procedures, analytical procedures, or when I say, you can understand the risk of the companies, and you are skeptical about how the company is operating and how is the management operating. If your mindset is on that direction, you should go for audit. Valuation is, uh, see, it can't be compared again, but valuation is a different thing. You have to be more analytical. You have to use various methods that I have that we will obviously undertake. You have to understand, you have to develop your professional expertise on that particular methods and approaches. You have to understand the business. You have to have a market fair idea of the market, how the companies are working, how the industry is growing. All these scenarios you have to consider. Then, if you can decide what exact interests you, then you can obviously have uh, I think, a fair idea whether you need to go to, you need to pursue audit or valuation. I hope that answers your question.
Sir, it seems like the answer was quite convincing. And after listening to this, even I regret my decision for not analyzing domains properly when I choose my articleship. Today's
Yeah.
session has been quite insightful. So we have one more question from a student asking, what kind of roles are expected in valuations?
Okay. So first and foremost, when we talk about valuation, there is equity analyst, if you might have heard about. There are various companies, JP Morgan, Credit Suisse. There are a lot of equity analysts role. uh, I think that might be a reason, because you have not heard about it, is majorly these roles are filled with MBAs in finance. Valuation was, or is, again, earlier it was considered to be a domain of MBA in finance, but over the period, industry or the businesses have understood that CA can have a very, very insightful, uh, can be very useful also in valuation, and can have a very insightful judgment on valuation. So again, uh, this is the reason, there might be a reason that you have not heard about the roles that valuation has. So again, equity analysts, there are various option analysts as well, valuing various options. Again, this is done by in the industry area. It is mostly it is filled by MBA in finance, but these are the basic roles that are in valuation.
Uh, I guess the query was appropriately answered. Sir, I would like to know, like, what is your experience till now? How can a person who's new to valuation excel more and learn more, like, without any exposure? As I am pursuing my articleship in taxation. So, someone who's
Hmm.
not been in valuation, if he or she looks forward to get into valuation, what are the key points that they must keep in mind?
See, I have known a lot of people who have who have not been into valuation. Their earlier expertise was, maybe indirect taxation, direct taxation. So it's a total career shift, and there is no starting point. Once you decide that you have to pursue your career in valuation, you have to switch. Obviously it will be a totally new role, new expertise for you, but there are a lot of experts or CAs like us who have shifted their career from taxation to valuation, and they are doing really well in their respective fields. So it is not a specific thing or a basic how to parallelly uh, might be basic things that you need to do. It is altogether a different shift of profession that you need, profession, or I mean the expertise that you need to cater.
Well, sir, that seems quite convincing. And now I feel that I should have met you a year before so that I could have, got quite a glimpse and insight of how do I keep and manage things. As we move forward to end of our session, I would request our Vice Chairperson, Mr. Parth Khakkar, to kindly deliver vote of thanks.
Hello, Madhur. Table. Thank you so much, Madhur. On behalf of the entire Vikasa WRC committee, it's my sincere honor to deliver this official vote of thanks toward this wonderful session on valuation cities. First and foremost, our sincere gratitude to our touchbearer of Vikasa WRC Chairman C. Ketan Sayaji for his visionary leadership and constant support towards student community. We are equally grateful to CA Piyush Chandak sir, WRC Vice Chairman, Secretary CA Jinal Savla ma'am, and Treasurer CA Dr. Fanil Shaji. Their constant encouragement motivate us. Lastly, our lighthouse of Vikasa WRC, Chairman of Vikasa WRC CA Jitendra Saglani sir, we are equally grateful to you. Your belief in us motivates us. Lastly, our superstar speaker of today's session, CA Chirag Kothari sir. Your explanation and valuation for the complex topics make easy for the students to tackle the valuation parts apart. Lastly, our fuel in the car, all the students of Vikasa WRC. You are the limelight of Vikasa WRC. We are equally grateful to you all. Thank you so much for participating. Over to you, Madhur.
Thank you so much, Parth. I assume we have all the students have gained a glimpse, and before we conclude our session, I would like to announce that we have planned an industrial visit to Ahmedabad, Gandhi Dham, and Statue of Unity, including many other prominent spots. The details for same are out on the site of WIRC. The ones who are interested for the same may enroll and do join us for this. Also, students are requested to stay tuned for more updates and more PPTs, as well as the PPT for today's session shall be shared with you soon in the group. Thank you.